And I'm fascinated by your framework this week because you're setting it up as a pretty powerful collision of both bullish and bearish forces. Can you explain it?
That's exactly the right way to describe it. We have the third year of a presidential term, which is nearly always a bullish year. 1939 was an example of an exception when Hitler was marching through Poland. And so if you don't have conditions like that, it tends to be a bullish year. We also have just seen gobs of breadth, which is nearly always bullish. My friend Walter Deemer created his breakaway momentum indicator, and that is triggered. That's a signal that's really reliable for forecasting bullishness. There's been a Whaley breadth thrust. We've seen the McClellan summation index get up high enough to signal escape velocity for the uptrend, but it had a bad signal last August. You got all those on the bullish side, but on the bearish side, you got the Fed that's going to screw up and raise rates farther than they should. You've got money supply already shrinking. We've never seen M2 shrink as fast as it's shrinking right now. And at the same time, GDP is still growing. So the ratio of M2 to GDP is shrinking faster than has ever happened in all the history of the monetary aggregates. We can go back to 1959 with M2 data. We've never seen this happen before. We know what happens when M2 growth is much faster than GDP, and we know that that shows up as a huge rally in the stock market about a year later. We don't know for sure what happens when you get a big drop in the ratio of M2 to GDP because we've never done one of these before. So it's a grand economic experiment that the Fed is trying. It seems fair to believe that when you yank away all the excess money that was being used to lift stock prices, it's going to have a bad effect this year.
Right. Of course, Fed officials get asked about M2 quite a bit. They always seem to suggest that it's an outdated metric, not as relevant as it was, say, 40 years ago. I assume you think that's folly.
It's partly true and partly false. 40 years ago, since you mentioned that, money supply aggregates had a coincident relationship with the stock market. And so all the brokers would all gather around their quote trick machine every week to get the weekly money supply measures because the stock market and M1 or M2 would move together. That started to change in the 80s and 90s to being about a 6-month lag time between them. And in the late 90s, it stopped working at all because money supply was shrinking because we were all moving to debit cards and online payments. And so we didn't need as much cash in our pocket to pay our bills. For the last 20 years or so, it's been about a 1-year lagging relationship. And that's why that chart you just shared that I sent over to you is showing that 1-year lag. It takes about a year for that effect to take place. And so this summer is going to be when it's really ugly. If you're using the rules of 40 years ago, then yeah, it's all broken and doesn't make any sense. But if you understand how those rules have changed over time as changes to the monetary system have affected how that money supply goes to work, then you can start to unlock the lock and get the understanding from the data.
Speaking of money being put to work, I know you're watching taxes as a percentage of GDP, which you argue is getting a little bit heavy here and creating unproductive uses of money at this point.
Well, it's just that when the government takes too much money out of the economy in the form of taxes, there's not that excess money left in the economy to looking for a job and lifting up stock prices. We've seen in the modern era, since Social Security was invented in the 1930s, that every time we get taxes above 18% of GDP, we get a recession. Every time. And there are a few things that you can say in economics that happen every time you get an indication, and this is one of them. And so it's not a surprise that stocks are having trouble in this environment with taxes as a percentage of GDP up so high. And Congress is not showing any inclination to change that. If we get a recession, the tax collections will fall and there'll be some excess money eventually. We had great money supply availability to the stock market in the early 2010s. We had it in the latter part of Trump's presidency when his tax cuts went to work and got tax rates down, and that helped lift the stock market in a huge way. And the Fed helped too in 2020 and 21. Now we got taxes up really high as a percentage of GDP. They're eating the seed corn. They're not leaving enough money in the economy to lift stock prices, and it's going to be another one of those bearish forces that are colliding with the bullish forces. And I think that the bearish forces are ganging up, and they're going to outnumber the bullish forces. And we're not going to have a pleasant year in 2023. And the last thing I would say, please don't shoot the messenger.
Right. The messenger is going to continue to talk as we get closer to the conversations this summer. Tom, thanks.